And what really is interesting about making this in a decentralized way is not really the decentralization per se, but the fact that multiple players can come together at a single place. And as a result, you have much better, much more open marketplace, and as a result, much deeper liquidity because everybody is able to connect on the same loan agreements through this smart contract that no one needs to trust, right?
Welcome to Tokenized, the show focused on stablecoins and the institutional adoption of real-world assets. I'm Cuy Sheffield, head of crypto at Visa. Today, I'm at Money 2020, recording a special episode here in the booth. We're missing Simon, who forgot his passport, lost his passport. You've got to give Simon some crap about that. But we've got a very amazing guest today. I'm here with Paul Frambot, CEO and co-founder of Morpho. How's it going, Paul? How's your day been?
Hey, it's been great. Thanks for having me.
Awesome. And then two quick bits before we get into the content. I need to remind you that the views or opinions of our contributors today are their own, do not necessarily reflect those of the companies they represent. Nothing we say should be taken as tax, financial, investment, or legal advice. Do your own research. And this podcast is made possible by Visa. All right, let's jump in. We've been going deep down the on-chain credit, on-chain lending rabbit hole together. Can you take a step back and just explain what is Morpho? What does Morpho actually do? And how do you explain on-chain lending to someone who has never gone down the DeFi rabbit hole before?
Right. So Morpho is on-chain lending and borrowing platform, meaning that we enable people to, on one end, earn yield on their assets, and on the other end, issue loans, right? And this is all done and settled in a non-chain native way, right? And so effectively we'll allow, someone like a Coinbase, for example, that is offering yield to their users, they would effectively power that yield through the Morpho network, right? And on the other end, you have people paying that rate that are effectively borrowing capital from the Morpho lenders. And those could also be like Coinbase, but could also be like fintechs and other players, like other exchanges, etc.
And so you used this analogy before of you see stablecoins as like a checking account, and then this concept of vaults as a savings account. Say more about that. Do you think every one of these fintech apps that offer stablecoins is going to then offer yield? And what is a vault?
Yes, that's right. So I think we really think of stablecoins as the way you store cash and transfer cash through blockchains essentially. But that's really just the first step, right? You have this checking account that's not giving you any yields, and effectively what you can do thanks to Morpho is deposit in what we call a vault, right? So you should think of a vault as a fund, but that's non-custodial and managed directly on chain, right? In a non-custodial way. And so what that means is that now all stablecoins, whatever they are, they're able to generate some yield, right? Yield that is powered on the other end by borrowers that are taking some financing from those stablecoins that are being lent out, right? And so we really think of vaults as this new way of bringing yield and all different kinds of risk profiles and compliance profiles to any cash that is sitting here idle on chain that is frankly currently just lacking investment opportunities, right?
So the way that I started getting really interested in this was, I feel like people understand stablecoins as being this programmable form of money. You can use a stablecoin within a smart contract. But then there's the question of, okay, what are smart contracts good for? What is the use case? And it feels like the use case has been representing a lending agreement, as code. And that's existed for a long time now. DeFi, I remember DeFi summer, in 2020, you had this crazy new ecosystem of lending and borrowing. And so, we did some work with the on-chain data team, partnering with Allium and Artemis, and found that $670 billion of stablecoin denominated loans were originated and dispersed over the last 5 years. And so when we say that, people are like, whoa, that's a lot of volume. What's actually happening? Could you talk a little bit about the history, how we got here and how DeFi has evolved? And then all of those loans are collateralized. And so for someone in TradFi or a fintech, how should they think about this idea of, okay, you're lending, but then there's this asset that's backing it and where that's going?
Right. So first to your point, we're leveraging smart contracts. At the end of the day, smart contracts are just a piece of code that runs on a server that's decentralized, right? And that's the blockchain. And what's the point in using smart contracts really is the fact that people can come together on terms and agree on terms without having to trust any central authority. And what really is interesting about making this in a decentralized way is not really the decentralization per se, but the fact that multiple players can come together at a single place. And as a result, you have much better, much more open marketplace, and as a result, much deeper liquidity because everybody is able to connect on the same loan agreements through this smart contract that no one needs to trust, right? And so initially, when DeFi lending started like 7 years ago, and the first ideas were, okay, a loan is like a promise of future value that the borrower is making to the lender. But in the non-chain world, in the beginning, no one knew what the other address was. So in order for the lender to be able to trust the borrower, you needed some kind of big trust assumption. And that was the collateral, right? So the initial idea was like, hey, you bring in some crypto collateral as a borrower, and I can trust you and I can lend you that stablecoin, and you're going to, because the reason I trust you is if you don't come back, like I get your collateral and I sell it and I'll make my position well, right? So that's really how this all started initially, through like people that wanted to take out some loans out of their Bitcoin, right? Mm-hmm. That said, there's nothing fundamental around, making this lending primitive strictly around crypto financing use case or crypto backed loans. It actually can achieve any form of lending agreement directly on chain, right? With all the benefits of having this open connectivity where everybody can regroup, right? So that's the most of the thing we've been exploring with Morpho is like, how do we progressively move away from just only have crypto collateralized loans, which have been, enormously successful. Like that's to your point, like $600 billion of loans originated, like sitting right now on the platform on Morpho, we have $15 billion of loans. That's great, but that's still a tiny drop in the ocean of what financing is and credit is. And our mission really is like to bring the entirety of on-chain credit on-chain. And that starts with crypto collateralized loans, but we'll extend soon with RWAs as collateral. We already have $500 million of RWAs as collateral. And then progressively, how do we move away from collateralized position to purely credit, under collateralized loans, et cetera, et cetera.
It's interesting whenever I talk to banks about this broader ecosystem. First, we never say DeFi. Like DeFi as a brand is terrible for banks.
It is.
It's terrible for regulators. We like on-chain credit, on-chain lending. We think those are much better descriptions of what this actually is. But then when you talk about crypto collateral, there's this idea that, okay, at first, that seems kind of weird and niche, but then you recognize there are a few $1 trillion of crypto assets out there. It's very liquid. It's globally accessible. It actually works, pretty well. But I think we're seeing a lot of interest in what can you do beyond that. You mentioned, now if you have tokenized treasuries, if you have tokenized receivables, can those go in a smart contract and then enable a loan to be dispersed? And then ultimately the holy grail of, can you actually do unsecured, uncollateralized lending using some of the same infrastructure? And so what do you see as some of the challenges and the things that need to be overcome if we're going to transition from purely crypto asset collateral to tokenized real world assets to uncollateralized? What doesn't exist today? Like, what's preventing us from doing that right now?
Right. So a few things. So first, it's at the end of the day, it's all of a trust problem. Like, will the lender be able to trust the borrower for the commitment that they're making, that they will come back with the money? And obviously, liquid crypto collateral is such a very good way to prove that you're trustworthy. But now, to your point, we're starting to see RWAs. And actually, it's one of the fastest growing areas of liquidity over the last 2 months or 3 months in Morpho. We went from 0 to 500 million. As I was mentioning. And so what was needed in order to have those real world assets as collateral was like, okay, we need to have this on-chain representation of something of value that is not crypto, that is not belonging to the chain, but that belongs to the outside world. And then the protocol needs to understand how to price it. So we need to craft those oracles and those primitives that are able to bring to the protocol the notion of price and what is the value of that trust that you're bringing with you from the off-chain worlds. And as we continue to expand the set of collateral that you can bring in, you could also imagine that we bring in some identity primitive, right? That can also foster trust. Like, you could even go as far as like, hey, I'm Paul, I'm like the CEO of the Morpho protocol. If I go to the Morpho network tomorrow and I sign with my name, there is some reputation behind my identity. And maybe the lenders on the other side of the network will give me a price, will give me a quote. And maybe it's not that good, right? Maybe they, I did not make any commitments, right? So maybe they have made me pay like 30% or 40%. But in order to foster trust, maybe I bring like a legal contract that I sign. I say, hey, under the laws of the US or of France, because I'm French, like, my physical collateral will be seized, and that helps foster trust, right? So at the end of the day, what we need to bring those various types of financing on chain is like, how can we bring those different primitives that can foster trust for the commitment that the borrower is making?
How do you think about the transitions from like these protocols as applications to infrastructure. So it seemed like in DeFi summer, and where most crypto native people, they're taking a wallet, they're going to a destination, to an application, they're connecting their wallet, they're either depositing to lend or they're borrowing from that protocol, but they have to know what the protocol is, they have to seek it out there. Now it seems like we're seeing this capability being embedded in the back end as infrastructure into existing apps. Like, when did that start happening? Can you talk more about some of the clients and like what they're doing with Morpho right now as infrastructure?
100%. I think there is, for a very long time, there has been this misconception of crypto is a product of its own, where it's something you should sell to the end consumer as it is. And frankly, when you think about it, beyond speculation, crypto is not really a product of its own. Crypto is infrastructure. It's a function, it's an engineering function that will be across all the large enterprises, all the large person that have to manipulate value at some point. They have to have some crypto PMs and some crypto engineers that understand how to manipulate value with the best possible tools available, meaning blockchain rails, right? And we learned this actually through building, meaning that initially, for example, the very first DeFi use case, the protocol itself was issuing the loan, meaning that the protocol was setting the risk parameters and effectively issuing the loan to the borrower. And what Morpho introduced, and we're the first to introduce this, was hey, actually, what if the protocol should just be very neutral, and we should have fund managers themselves issue the loans, and Morpho is just the immutable, unopinionated rail that's just going to do the accounting of interest, and that is going to do the liquidation, and that's going to connect lenders with borrowers as a network, right? And as a result, all those fund managers that were in, TradFi rails started to see the benefit of being on-chain and start rebuilding the entirety of their fund using crypto as an infrastructure to distribute product that they would have, managed and distribute in the TradFi world, right? Except now that they benefit from all the openness that makes the pricing much more competitive, which is probably the number one interest of moving on chain. Then obviously they have all the 24/7 and the aspect of blockchains where you can get liquidity on any forms of financing, immediately with interest being accounted every second. You have the integrability, which is much easier for a fintech to integrate crypto rails because everything is open source. And then finally, you have transparency, right? For example, when, Crypto.com or Gemini offer crypto-backed loans on Morpho, well, they can show to their users, hey, here is the collateral. It's not transferred to an FTX type of structure where the collateral is being lent out to another entity. Every single user can audit at every point in time where the money is, right? Which fosters trust in the product, et cetera, et cetera.
Yeah, that is a super important difference when what we saw last cycle with CeFi. There are a bunch of these lending applications that were offering yield on one side and loans on the other side, but you had no idea how many assets they actually had. They said they were over collateralized. Maybe they were, maybe they weren't. So having that visibility into 100%. All the assets in the protocol is super
FTX
important.
was actually the perfect example of a company that was offering a crypto product with a TradFi infrastructure, as opposed to try to do a normal financial product powered by crypto infrastructure, which is the right way to go about blockchain technology in general.
Yeah. And then what about the permissionless nature of all this? If you talk to a bank or a fintech and you say, okay, why don't you integrate a lending protocol where your customers are going to receive a loan from someone across the world and we don't know who they are? It's really weird if you're lending or borrowing and you don't know the identity for most businesses in TradFi. How does that play out over time using the capabilities of Morpho?
100%. So I think the word permissionless has been probably doing a lot of harm to our ecosystem overall, because it has been understood as DeFi protocols, and they were, and on-chain finance in the beginning should always be a single pot where everybody gets to commingle funds with everybody. It's not what it is today, right? If you take the Morpho protocol, for example, we think of it as providing a toolbox where, as a lender or as a borrower, you can impose the condition that you want or expect from the other party, right? So if you're a lender and you want your user to have a specific KYC, you can programmatically expect this from them and enforce this, right? The same way, if you expect your vault depositors to be accredited investors, you can also impose this to them. So we like to think of Morpho as a permissionless infrastructure for builders, meaning that you can build the financial rails that you want. Whether it's open for everybody, you can do it, or restricted to just two parties, you can, right? But it's really fully complete.
And then what does this mean for banks? Because it's interesting. It seems like the crypto ecosystem, they're really leveraging this idea of composability. You mentioned you have Coinbase, you have crypto.com, and it's fascinating that you have a Coinbase customer depositing into a vault that is lending, that it might be a crypto.com or a Binance customer that's borrowing on the other side. And so it's almost like there's this lending network that's being built out where traditionally, lending happens in this very vertically integrated. You have a bank that's lending to their customers, and they're competing with other banks that are lending to their customers. There's not really the concept of a credit network that exists. And so how should banks look at this today? And you've started to talk to some of the larger institutions, like how are they thinking about participating and what it means for their role in the longer term?
Right. It's actually on point because when boarded the first bank like 3 weeks ago on Morpho, like Société Générale was like one of the largest European banks that's actually moving their loan book progressively on chain. So to your point, the entire value of building this on chain is now everybody can connect into a single venue in a single marketplace, creating a level of efficiency and liquidity that is impossible to think on like a TradFi route generally. And the main reason is very simple, is like every single bank has its own backend, its own like books that are fragmented with one another effectively. Like on-chain finance is the opportunity to have this global connectivity layer for markets where effectively everybody gets to put out their bids and their offers on what they're ready to lend or what they're ready to borrow. And as a result, you get more better pricing, more efficiency. So if you're looking at it through the lens of a bank, there's multiple approaches you could take. The first thing is you could become a non-chain asset manager yourself. Like, same way SocGen got involved with Morpho, is like they effectively like deploy their new vault. And they welcome customers' deposits into that vault, and they invest it by issuing various types of loans directly to on-chain borrowers, right? So that's one type of use case that is increasingly popular among institutions. The other category is playing the other side of the market. Let's say you want some short-term liquidity or some short-term financing directly from on-chain capital that runs 24/7, that is ultra competitive, out of which you're going to get the best rates. This is another opportunity for banks to get financing on like some various use cases.
Yeah. It feels like an internet of credit where you could still have banks own the end relationship with customers. They could capture the intent that a customer wants to borrow, but then route it into a protocol, instead of being limited just by their balance sheet. And then you talk a bit more about the global nature of this. And, whenever people think about stablecoins, first thing they think about tends to be cross-border payments. And they recognize that stablecoins you can transfer 24/7 across the world. But this is all cross-border lending. Like you have people in the United States that are lending to businesses in Brazil, and you're dispersing the funds, from a vault, directly to an end wallet in real time. And so what does this look like? How do you create like a global cross-border lending ecosystem? How do you manage the local regulatory requirements? And like, how does that play out in the next few years?
It's a good question. So I think what we're saying is that we have like 50K banks currently in the world and credit unions. They all have their segregated backends with their segregated database. A stablecoin at the end of the day is a database, right? It's a single shared database across all those different players that is effectively setting who owns what. And that's effectively marvelous because now there is this shared computer, this shared base layer where everybody is able to interoperate in a very easy way for payments. But to your point, a stablecoin can be a database for payment, but could very well be a database for credit as well. The same, and effectively, that's what vaults are. Effectively, is like making stablecoins a credit network as well. Now, there's a lot of questions around like, hey, we have all this global connectivity layer. How do we approach regulations, for example? I think the way on-chain finance approaches regulation is pretty clear, and it's the same way internet protocols approach regulation, meaning that everybody should be locally compliant to their jurisdictions and apply the guardrails that they need to. But the protocol in itself should externalize the compliance management. So if you think, for example, HTTP does not implement the 210 like countries' different regulations. They get the websites to effectively make sure that they're locally compliant. And the reason this is so is because you want HTTP to connect people, whoever they are, wherever they are. And then the guardrails are imposed at the application level. So I guess the TLDRs of this is like one should regulate apps, not protocols, is really how to put it simply.
Yeah, it's a fascinating space. We're going to spend a lot more time around on-chain credit and lending on the show going forward. That's all the time we have today. Thank you so much, for listening. Paul, where can people find more about you?
We are Morpho Labs on Twitter and morpho.org on internet.
Awesome. And I'm on X at Cuy Sheffield and visa.com/crypto. If you haven't already, please subscribe to Tokenized on Apple, Spotify, wherever you get your podcasts. If you enjoyed this, please leave a review. Special thanks to our audience here around the yellow booth in the middle of Money 2020. This was a lot of fun. Thank you all for listening.